Welcome to this explainer. Today, we're going to break down exactly how to start building long-term wealth from absolute zero. And we're doing it without all that confusing, intimidating Wall Street jargon that usually makes people tune out. Look, if you've got some extra cash sitting around and you want to put it to work, but it feels like you're trying to learn a foreign language, you're in the right place. We're going to take this step by step.
Now, to understand why simply saving your money just isn't enough anymore, all you have to do is look at the price of your favorite caramel frappuccino. Think about it. Not too long ago, that drink was, maybe $5? Today, it's jumping up to $8 or $9. That price jump is an invisible thief called inflation, and it's quietly eating away at your money's buying power every single day. So if your cash is just sitting under a mattress or in a basic savings account, it's actually shrinking in value.
Here is our 5-step roadmap. 1. Why you must invest. 2. The magic of index funds. 3. Before you invest $1. 4. Making your first trade. And 5. The secret to winning. Section 1. Why you must invest and stop losing to inflation.
Growing your money isn't magic. It's actually pure math. Your wealth essentially grows in two primary ways. First, when you buy a stock, you are literally buying a slice of a real company. So if a company like Nvidia crushes its sales, launches new products, and brings in huge profits, the overall value of the company rises. And because you own a piece of it, your investment goes up right along with it. The second way is through compound interest. Albert Einstein famously called this the eighth wonder of the world, and for good reason. It's the snowball effect. Your money makes money, and then that new money makes even more money, rolling down a hill and getting bigger and bigger the longer you just let it roll.
Moving on to Section 2, the magic of index funds, or why you should just buy the haystack. A really common, massive mistake beginners make is chasing hot individual stocks. I get it, it's super tempting, right? But history shows us exactly why that's a terrible idea. Just because a stock crushed it last year absolutely does not guarantee future success. Take a look at BlackBerry. It once peaked around $145 a share before just plummeting to $10. Or Kodak, dropping from $90 all the way down to a single dollar. Buying individual stocks based on past hype, well, that proves to be an incredibly risky game. So the crucial point here is captured perfectly by this famous investing philosophy from Jack Bogle, the founder of Vanguard. He tells us to stop hunting for a single winning stock. Seriously, stop looking for the needle in the haystack, and just buy the entire haystack all at once.
This brilliant philosophy brings us to what is basically the ultimate beginner tool, the index fund. An index is literally just a list of companies, like the S&P 500, which lists the top 500 companies in the US. A fund is a pool of money from everyday people like you and me. Put them together, and an index fund minimizes your stress and your risk by taking your money and spreading it out to buy a tiny piece of hundreds of companies simultaneously.
Let's actually look at how diversification works in a real-world S&P 500 ETF, like SPLG. When you buy just one single share of this fund, your money is safely spread out. Look at this breakdown. About 7% goes to Apple, 6% to Microsoft, 6% to Nvidia, and the rest is distributed across hundreds of other massive companies. You're basically putting very small eggs into many different very strong baskets. That way, you're protecting your wealth if any single company happens to struggle. But hey, a quick word of warning when you're choosing your funds. You always want to check the ETF's expense ratio. These are basically just the administrative fees that the fund charges to manage the portfolio. If you aren't paying close attention, high fees will quietly eat away at your long-term profits. So a really great rule of thumb is to keep that expense ratio well under 0.5%. All right, Section 3, before you invest $1, make sure you check these off first. Okay, you absolutely must complete these 2 steps before you start buying stocks. First up, you've got to kill off any high-interest debt, especially credit cards charging over 7 to 12%. Trying to invest while holding bad debt is honestly like trying to fill up your car's gas tank when there's a massive leak pouring out the bottom. You gotta plug the leak first. Second, secure a 3 to 6 month emergency cash fund. Look, life happens. Cars break down. You need a safety net so you never have to panic sell your investments at a bad time just to pay for a flat tire. Think about the math here for a second, because it is incredibly powerful. The stock market averages roughly a 7 to 12% return historically. But if you are holding thousands in credit card debt at, let's say, a 25% interest rate, wiping that debt out immediately is mathematically identical to a guaranteed 25% return. That is an easy, zero-risk financial win that the stock market simply cannot guarantee you. Moving right along to Section 4, making your first trade, step-by-step execution. First things first, you'll need to choose the right environment for your money. And there's a major trade-off here. On one hand, you have a taxable brokerage account, or TBA. This gives you total flexibility. Put in what you want, take it out when you want. But your profits will be taxed. On the other hand, you have a retirement account, like a Roth IRA. Here, your money is locked up until you're 59 and a half, and there are strict limits on what you can put in. But the massive, undeniable superpower is that your growth and your withdrawals are completely tax-free down the road. Once you actually pick your account type, the process of buying takes maybe 5 minutes. You just go to a major broker like Fidelity, Vanguard, or Schwab and open the account. Next, link your bank and transfer your cash over. Then, use the search bar to find your chosen ETF ticker like SPLG or SEHD. Finally, submit a simple market order to buy your share. Hit the button and boom, congratulations, you are officially an investor. Finally, Section 5. The secret to winning and why patience pays off. If we trace the S&P 500 over time using the SPY ETF, we can clearly see the absolute necessity of long-term patience. Imagine you bought a share back in 2007 for $154. Then, boom, the terrifying 2008 financial crisis hits and your share plummets to $73. A lot of people panic sold right there and locked in a massive loss. But look at this timeline. If you just zoomed out, ignored the terrifying news, and held on, you would have broken even by 2013, doubled your money by 2018, and today, you'd be sitting on nearly a 4 times return at over $500 a share. The data proves it. Panic selling is literally the ultimate wealth killer. Studies show that jumping in and out of the market because of fear is devastating. In fact, if you miss just the 10 best surge days in the market over a long period, you can violently slash your long-term returns by over half. Leaving your money alone might have netted you $200,000, but missing those 10 key days could drop you all the way down to $144,000. Remember, it's always about time in the market, not timing the market. So you now know exactly how to beat the invisible thief of inflation. You understand the magic of buying the whole haystack with index funds, you know how to clear your financial runway, and you grasp the psychology required to weather the market storms. You literally have the step-by-step roadmap right in front of you. So the only provocative question left to answer is this. Armed with all of this knowledge, exactly what day will you finally decide to make your money start working